Hi, welcome to the Market Alert for Friday the 15th of July 2016. So yesterday the MPC in the UK kept interest rates on hold at 50 basis points, 0.5%. And of course, as I said in yesterday's Market Alert, this would lead to a sideways trading range if that were the case. And that's precisely what we saw in the first part of the trading session now. I mean, you can see that there's no even a blue line visible there, so I'll just bring this in so you can see that the range between these two lines is 50 points. You can see how narrow the range was. So the first trade, the market trading up, filling around about 16 points before the market reverses and then puts in a sell signal, which is then filled with a loss on the first trade of just over 22 points there. The market eventually works its way all the way down to the evening session, but it was a very, very slow and painful trade as the market moved lower, but eventually getting down to the scalp there to recover some of the first losing trade. And then we had a profit on the final trade as the market moved its way back. And then of course the market's been sideways on the overnight market as well. So if we look at the daily chart, you can see that we've got a bit of an inside bar going on at the moment, which means that we've got the higher and the low inside of Thursday's trading range. And again, just check out this volume. This is absolutely dire. This is prices being marked up. This is not new buying coming into the market. This is a market that's moving higher on the expectation that Japan are going to print helicopter money and that the US will follow at some point. The insanity continues. The central bankers haven't got a clue. They're running out of ammunition, and the market at the moment is being ramped to the upside to take effect of the fact that they are going to have to resort to some form of QE, whether it's helicopter money or another round of printing more and more and more debt, also with lower returns on it, negative and zero, in order to keep this system alive in its present form. News-wise today, what have we got? Carney speaking at 1 p.m, so that'll be enlightening. And what else have we got? From 3 p.m, we've got prelim UM consumer sentiment. This is out, forecast to be slightly lower, so that could have a bit of a negative impact. Don't forget, we've had the market move up for 5 days now, making new all-time highs. We are due for a bit of a pullback, at least for 1 day. So again, keep that in mind. Plus, you've got that dreadful situation out in France that will take focus away from the markets as well. So, but we are due for a bit of a pullback, unless, like I say, the market wants to finish on a very high note today and trade through the all-time high now, which is 18,559. And finally, in the implied volatility, a new record low, 10.25 for yesterday. You see there, new low for the 14th. Breaking records here with the implied volatility. I would love to see this below the 10% area, because the lower this goes, the bigger the correction is going to be in the underlying market, the bigger the down move that will come as a result of this moving lower. Could do with the blue historic volatility moving down, but it is a lagging one, whereas the implied is more of a real-time measurement of the risk in the market. So not too concerned with the blue line. It's the implied volatility which doesn't lag, shows the real-time potential risk for option sellers, which is a great barometer of what the market is likely to do going forward. And that is, as we saw with the Brexit, where we saw the market tick up a bit as far as the implied is concerned and the underlying market move lower. And then of course it's now pulled back as the underlying market has moved higher post-Brexit and making new all-time high. So this is again a great indicator that something is afoot as far as a correction is coming in this market. Like I've said before, this market is very reminiscent of 2008 crash. In 2008 January, February, we had a big correction in the market, and then everything was pumped back to the highs during the spring and then into the midsummer, but by August the whole thing fell apart. And again, we had the same thing in January, February, when the Federal Reserve increased interest rates by 0.25%. The Dow lost 2,000 points. And then during February, Yellen got on the phone to Draghi and Carney and said, look, we've got to stop this. And then the market's been pumped up ever since. And then, of course, we had Brexit, post-Brexit, and now we're seeing the market move back to the upside, making those new all-time highs. So very, parallel there between the two. Will the market crash? Who knows? But one thing's for certain, the implied volatility is certainly giving a good indication that we have a major correction coming in this market. Record lows in the implied volatility. Right, that's it. I will see you in Monday's Market Alert. Thanks for watching. See you in the next one.